Hello and welcome to the Capital Market on Channels Television. I'm Edidiong Iwang. The bearish performance in the stock market extended for a third consecutive week as the rise in yields in the fixed income market continued to dampen investor sentiment. The all-share index shed 0.63% week on week to close at 40,186.70 points. Now, that made the year-to-date return swing into the negative territory, settling at minus 0.2%. Activity levels were weak as volume, value, and deals traded declined by about 42.6% and 22.9% week-on-week, respectively. Notably, sell-offs in Stanbic Bank, Boa Cement, and MTN Nigeria drove the weekly loss. The sectoral performance was broadly negative, except for the oil and gas and banking sectors, which posted gains. The insurance, consumer goods, and industrial goods sectors recorded losses. The unlisted securities market also saw weekly declines as the NSI shaved off 2.50% to 717.84 points, or about 2.5 million units worth 84.18 million naira were exchanged in 43 deals. Now moving to the fixed income market now. The bond secondary market remained bearish as demand weakened following Wednesday's bond auction. Investors continued to price in the higher rates at the treasury bills market, and the market reacted to another inflation uptick. The average yield expanded by 37 basis points to 9.4%. Across the benchmark curve, average yields at the short, mid, and long segments sustained their expansions as investors sold off on bonds. On Friday, however, there were 39 deals worth 17.18 billion naira. And the Treasury bill secondary market turned bullish as the average yield across all instruments declined by 28 basis points to 4.1%. Now, just like in previous weeks, activity in the almost secondary markets primarily drove proceedings in the broader markets as local investors reinvested excess liquidity from OMO maturities. The average yield in that space contracted by 32 basis points to 6.4%. On Friday, there were 40 deals worth 4.92 billion naira. The trading in the Nigerian Treasury bills market was relatively muted as average yield increased slightly by 2 basis points to 1.5% as weak sentiment persisted. On Friday, we saw just 2 deals worth 10.61 billion naira. Let's turn our eyes now to Nigeria's pension industry, which has evolved over the years from one with predominantly public sector participants running a defined benefit scheme to a mandatory defined contribution system for all government and private sector employees in the country. Now, how did the pension industry perform in 2020, and what should we be expecting this year? Tony Odutola, the Deputy Head of Investments at ICO Pensions, joins us now to talk more about this. Good evening, Tony. Should I be saying Happy New Year? I haven't had you on the show in a bit.
That will be very much in tune. Happy New Year and good evening.
So let's begin with your review of the pension funds market in 2020. How did that market perform? I mean, with the COVID-19 pandemic, job losses, how was the market generally in 2020?
Okay. I don't know if I should agree with you that we are a market. We are also participants in the market. So whether it is debt market, the equities market, whether primary or secondary money market, all of that. But I sense that what you would like to see is in terms of performances of the investment that we've made, how that it's turned out in 2020. Interestingly, 2020 was a good year. Good year in the sense that, so you had, if you remember, the last quarter of the year where the equities market returned 50.03%. Of course, that would mean that investments in that space would have received that bump. The interesting thing about, I heard where you talked about the fact that market was bearish and yields were going up in the fixed income space. The interesting thing about that is when you hold fixed income assets and markets, becomes bullish as it was in 2020, it means the value of your investments would have gone up. So if you sum up all of the parts, that make up the total, 2020 was a good year. Returns were in upper double digits, and compared to previous years, it was quite a good year for us.
Okay, but with the pandemic, and job losses and some, pay cuts in some instance, what was it like for PFAs in terms of payout claims?
Okay, so if you remember, it's one of our previous chats, we had talked about the fact that we expected this to happen post-COVID, and that it will be delayed because, of course, the regulation says you would have a minimum of 4 months between which you'll have been laid up before you can then set up to have a claim. What we've seen, I don't know about the industry as a whole, but what we've seen is between 100 and 150% jump in terms of claims. So 100% will be in terms of volume, and 150% will be in terms of value, against the same period. So clearly, there's been job losses that has brought about those 25% request, and we still think more of it will come in. There was a big jump in December, somewhat muted a little in January, but we still think we still see a bit more of it as different people come forward.
So with inflation at over 16% now, what are the realities, this year in terms of above PFA returns? Because we don't see that coming down anytime soon. So what's it going to be like?
Okay, so let me be as blunt as possible. The realities will be that, returns are very much likely to be negative in terms of real returns. Negative because the pillars for which inflation rests on are pretty much still saying things will be negative, if you like, and yields are gradually taking an upward trend. But do we see the sort of returns in that space to be able to give you positive inflation-adjusted returns before the end of the year? Not too sure. So maybe, yes, you will talk about a bit of strategy that you implement to be able to make the most of what is available. But the reality, the stark reality will be we are likely to be making negative inflation-adjusted returns.
Okay, so we've gotten your review, of the pensions industry in 2020.
Yep.
And we've spoken about returns for 2021. But what's your general outlook for the pensions industry this year? Well, at least for you guys.
The market generally, right? I think it will be a very interesting year.
Okay.
Very interesting because things are still largely fluid. You've seen movements across. In this year alone, you've probably seen 300 basis points movements in the bond market, and one of the things that those sort of movements present are opportunities, depending on what side of the divide that you sit. The opportunities for you to book in gains or book in losses, as the case may be. But the reality is, those you will still largely see this year. I have a gut feeling that the second half of the year will probably be a lot more interesting. The first 2 months haven't been particularly, beautiful, but if you go back to previous years, we would see where the year starts at a certain, level. One key player that is important will be the regulatory institutions. Pronouncements and actions that they take tend to, determine how markets move. The bifurcation of the market, the previous year sort of gave rise to the returns that I spoke about earlier.
Yeah.
So there are several moving parts that each one of them, have its impact on what is likely to happen. But I foresee a very interesting year.
Okay, well, we'll keep our fingers crossed for that. In the area of using pension funds as equity to boost mortgage financing, we know this PenCom had mentioned this, I think, in 2019. What's the update on that? And, what have you guys as ICO done in regards to that?
So the update on that is we're still at the stage where we are consulting with various groups. The important thing is that you have multiple groups within the mortgage value chain, maybe construction or home production value chain, that are extremely important. So whether you're a provider of capital or you are the developer itself, or you are, I mean, with all of these various parts need to come together, and that hasn't been fine-tuned yet. So, I mean, you take a look at where the longest dated instrument is at the moment, and you ask yourself if you can build a mortgage on that. That's on one side. On the other side is in terms of supply. Supply now will be, say, land, for instance, cost of construction, how many people in the working, how many working class people can genuinely be able to afford that. Even if you say, sometimes you've had figures like 25% being put forward. And the question will be, what exactly is the contribution or balance of each of the contributors, that 25% now becomes, something that is able to get you an accommodation that you would like to have in the location that you like to have it. So there are a number of discussions still going on, and we still don't have traction to the point that now becomes something to work with. I mean, one of the key areas again will be even the act that sets up the Pension Act in itself probably does not recognize that yet, and that of course will still need to be put into consideration when all of this will be done. So I think we are still, a long way out, but discussions are going, which is a good thing, and then gradually we can begin to get to the point where that now becomes what we can begin to run with.
But how is this going to work, though? Can you just run us through?
You see, so that's part of where the issues are. Why I said we are at the point where, yes, we are talking. That's a good thing, but it's still a long way out.
Okay.
So if you have your funds with a PFA investing to give you the best returns possible, that's on one side. On the other side, cost of building is a little high, and then you want to bring that down. There's a tie-in, with returns. Of course, the question down becomes: do you want to separate the monies for certain people? So there are a lot of moving parts that needs to be answered. Well, largely is the fact that on the macro space, you still need to be able to get rates to a certain level for that to, for you to activate that. And one major area will be titling, land and titling. It's a whole lot of mix that needs to be done.
So we know that infrastructure is one key issue we have in Nigeria. Is there any way pension funds can be used to support, in bridging that infrastructure gap in the country? Is it possible?
Okay. From what I know, pension fund already does that, and I would explain what I mean by that. So if you're looking at it from either issuances by corporates or by government to the market. So I know, for instance, that the pension fund is very much into infrastructure funds and bonds, that have been put forward. The government in itself has come forward with various issuances. We've talked about right from the 3-year paper, available, to the 30-year bond available. So the question really will be the application of those proceeds. Okay. So maybe there we can say the government needs to increase the proportion of sukuk, for instance, that you have in its issuances, because that seems to be one asset class that we really can tie to infrastructural development. So should we ask for more of that so that we can then see that this goes specifically for this? But if you ask, on the average, about 70% of investments in the pension space is actually invested in government bonds. So the question will be, what are those funds being used to generate? Okay.
Well, we'll just hold a thought there. Capital Markets continues when we return from this break. Please stay with us. Welcome back, and thanks for staying with us on the program. We have Tony Odutola, the Deputy Head of Investments at ICO Pensions. PENCOM issued a deadline for the reclassification and valuation of PFAs under FIRS 9. IFRS, thank you, 9. So what exactly is this about?
Okay, so prior to that change in how valuations were done, the Nigerian GAAP was being used. So the Nigerian GAAP was what preceded the IFRS implementation. And then by the time this came about, you had a different way by which assets were classified and valued, and of course, what that meant was that you would have to change your ways from what you were used to some other things. So what you then had was there's a bit of if you like timelines, different timelines being set by different PFAs as to when certain things will be done, and also after they've been done, changes here and there being occurred, changes that, in my opinion, are a function of knowledge gap.
Okay.
So you now have better knowledge of what you're supposed to do, and so you need to tweak a little bit, to be able to say exactly what it is that you would like to do. And so I think PENCOM at some point came to realize that, look, we need to draw the curtains at some point, and of course that deadline was issued to the market.
Well, that deadline elapses on the 28th of February, which is next week, Friday. Have you at ICO Pensions, been able to adopt this new business model? And do you have any idea of what the general adoption has been like for other pension companies?
Okay, so the first question, has ICO Pension been able to do that? Yes, so that is done and closed. But what I know that it varies across different PFAs, varies to the extent that, like I mentioned before, the types of assets you carry, how you so I can give one example, for instance. So I'm aware that in some places there were a blanket classification to say, I'm trying to say this without getting too technical, but just to say you've separated your assets into two different buckets,
okay,
and it goes from Fund 1 to Fund 4, the same mix.
Okay.
But the reality then is that the risk of each of the funds are different. And so that blanket, classification should not apply. And then you have to tweak to be able to show the different risk of the different assets that you carry. So that's just one of the examples that I gave about your limited knowledge of the subject, and as you go on, you get to understand and realize that, okay, there's a bit more to understand, and it's not just even the industry players, the regulator itself. Okay. Everyone was learning as we were going, because that was pretty much a new
terrain.
Yeah. So that happened. But for us, yes, we have done, that is done and dusted. And then you actually even will have to report on a monthly basis to PENCOM,
okay,
what how that is going, and pretty much.
It was good you've been able to get that out of it. Let's talk about the markets now. We've seen yields in the fixed income space, especially bonds, rise lately. How long do you think this will go on for?
Interesting questions. It always comes a bit under different guises. So where do you see yields? Where does this go? To be honest, I'm not sure anyone can say with a certainty that this is where it will settle. What you can then do will be take a mix of the elements that help you to have a sense of where this will go. So you want to go historically, where have previous issues in terms of coupons, where have they been issued? So if you go along the yield curve, it gives you an idea of all of that. Maybe you find an average of that, you have an idea of where this will settle. You take a look at what is going on in the macro space, maybe around the world, and see, because at every point in time, you find out that the figure is not static. In other words, we've seen issuances of 16 points level. We've seen issuances of 9.8 levels. Prior to that, I think the lowest was 10. So that's the movement.
Yeah.
So it's for you to be able to understand that at what points do you think that you are comfortable? Of course, you may need to also add the greed of the manager. What is considered okay for you? Is it 12%? Is it 13%? Is it 14%? So, I mean, that will change. If you speak to different managers, you will see, you probably get different responses. But all in all, you could use those elements, put them together, and then come to a midpoint and say, from this point on, I think I'm comfortable. But to be able to say specifically this is where it will end, it will be a difficult call.
I mean, the market is hard to predict, so...
If I can, I won't be here.
Well, fair enough. What has participation been like for PFAs in the bond and treasury bills auctions? I mean, there was a bond auction last week. The week before that, we had a treasury bills primary market auction. So far this year, what has participation been like for PFAs in these auctions?
In the primary market space, for NT bills, maybe. I mean, I can't speak for the entire market, but for NT bill, because you are in this season where yields are rising, and you probably still expect them to rise. So it will make absolutely no sense to go buy such instruments and keep on your books, especially if you were to be trading, instruments, because you'll be losing money from day one. So I would argue that very few, would extend participation to that space as of now. However, with the last two issuances in the NT bill and the bond market, by the DMO, beginning to look like, okay, maybe we are getting close to where interest could be poured all over again. So directly answer your question would be, there'll be a bit of apathy before now. And right now we are getting to the point where, okay, are we approaching what you consider a favorable midpoint that I explained earlier?
Yeah.
Are we around there now? If you're around there, then maybe you can begin to put in your bid. All of the monies that have been stacked up in cash that we talked about, that, go and stay in cash. Is it time to begin to bring them back out and, take a stake in the long-term instruments? But on the average, I do not think that there's so much that will have happened this year in the auctions. From what I saw, the last bond auction result was that participation was very, very low.
Yeah.
Very, very low. Because again, like I said, it makes no sense if yields are on the rise and then you begin to stake.
So the equities markets, we saw a rally, towards the end of the year. And then in January, the Nigerian Stock Exchange was tagged the best performing market in Africa. So with the 5% year-to-date returns, unfortunately, all of that has been wiped away. We're now in the negative for year-to-date returns. So how has playing in the equities market been like for PFAs?
So by regulation, we are supposed to have some stake. Strategies are different for different managers. Personally, I would view that market as really long-term play. And except there is a major shift in, expectations, I don't think you should sell. I mean, you're going to be seeing those volatilities, but then if you have your eyes on dividend yields, for instance, if you have your eyes on capital gains that will come from a change in macro conditions, for instance, why are you leaving? Except, of course, there's a compelling story about a sector that needs you to excuse that from your portfolio. So in terms of how we play, we hold and keep largely. We would only sell, of course, if those things occur. So yes, will the diminution affected our portfolio? Yes, but it's usually momentary. But again, you can almost tie the drop to the rise in yields. So I mean, there's likely to be, okay, hold on, let's see where this goes, and then you can tie that together really, because the moment you saw 100% in terms of movement of yield in the NTB space, that began to happen.
Yes.
Then there was the bond auction that happened again. So, I mean, likely, very much likely, what you would do is
Investors
to,
are to wait and see.
Yeah, exactly. See where this will go.
Okay. All right, Tony, thank you so much. It's always a pleasure having you on the show.
Same
Tony
here.
Odutola is the Deputy Head of Investments at ICO Pensions. Well, that's it on the program tonight. Thank you for watching. I'm Edidiong Iwang. Do stay safe.